8 nations once pooled their gold to hold a price steady, and they told the whole world it would never break. It broke anyway. Not slowly, not with a warning, but in the space of a single stretch of days, the moment the metal in the vault ran too low to keep up the act. That is the story I want to lay against silver today, because the same kind of setup is sitting right in front of you, and almost nobody will explain to you how it actually works. So let me answer the question in the title before I earn a single minute more of your time. The silver trap is real. It is not a slogan, and it is not a scare. There is a genuine, defensible case that the price you watch on your screen is being held down by a machine that Wall Street built on purpose, a machine that runs on paper claims to metal that does not physically exist. And the trap is not the price. The trap is what that machine is designed to make you do. It is built to make you doubt what you hold, panic when they slam the price, and sell your real metal into the very dip they engineered, so it can quietly walk across the table into stronger hands. That is the case. It is not a guarantee, it is not a promised price, and it is not personal financial advice. But by the time I am done, you will understand the mechanics well enough to never be the one holding the short straw. Here is the concrete fact I want you chewing on right now, before any story, because it is the tell. Silver has run a structural deficit for years, several years running, where the world uses more of it than it digs up. And above ground stockpiles get drawn down quietly to cover the gap. And most of that silver is not sitting in a vault waiting to come back. It gets burned into solar panels and electronics and never returns, dispersed in amounts too small and too scattered to be worth recycling. Gold gets hoarded. Silver gets consumed. So while the paper price sits there looking sleepy, the actual physical metal is getting scarcer underneath it. Hold that thought. It is the whole thing. Now let me take you back to that pool of nations, because this is not theory. In the years after the war, the major currencies of the world were tied to a dollar that was itself tied to gold, and the agreed price of gold was $35 an ounce. That was the anchor the entire system leaned on. But by the late 1960s, the pressure was building. There was more paper money in the world than there was gold to back it at that price, and everybody who could do arithmetic knew it. So 8 leading nations formed a pool, and they agreed to sell their own gold reserves into the market whenever the price tried to rise, to force it back down to 35 and keep the illusion intact. And it worked, for a while. Every time gold tried to climb, the pool sold, the price sank back, and the newspapers reassured everyone that all was well, and the anchor would hold forever. The men who understood what was really happening watched the reserves drain. Because here is the thing about defending a price by selling the real asset. You can only do it as long as you have the real asset. Every ounce you sell to hold the line is an ounce you no longer have, and the closer the vault gets to empty, the closer the whole performance gets to its final act. Then the moment came. The demand for real gold surged. The pool poured out reserves at a pace it could not sustain, and the metal ran low. And when the metal ran low, the suppression did not gently ease. It ended overnight. The pool was abandoned. The official price and the real price split apart, and the market price of gold began the climb that the pool had spent years pretending was impossible. The people who had trusted the reassurances got the number the establishment swore they would never see. The people who understood that a price defended with a finite pile of real metal is a price living on borrowed time, those people were already positioned. Now hold that next to silver and watch how cleanly it maps. In my years around the gold and silver world, I have watched this exact shape play out more than once, and it always rhymes. The price of silver is not really set where the metal changes hands. It is set on paper, in a market where enormous quantities of silver are bought and sold as contracts, promises, claims, most of which will never be delivered as an actual bar to an actual person. There are far more paper ounces floating around than there is registered physical metal available to satisfy them if everyone showed up asking. And that gap, that towering stack of claims on a thin pile of real silver, is the modern version of that pool of nations selling gold they were slowly running out of. Here is where it gets strange, and this is the part the financial channels will not sit you down and explain. Because the price is set in that paper market, a handful of large players can lean on it. When silver gets frisky and starts to run, the mechanics of that market can be tightened. Margin requirements get raised, meaning it suddenly costs far more to hold a position, and a wave of leveraged traders gets forced to sell all at once, and the price drops hard, even though nothing about the actual supply or demand for real silver changed one bit. We have watched silver fall by roughly a third in a matter of days off exactly that kind of squeeze, with no fundamental reason behind it. Nothing was dug up overnight. Nothing was suddenly discovered. The plumbing was simply tightened, weak hands were flushed, and the metal moved. That is the trap. It is not one event. It is a rhythm. They let it run a little, they slam it. The financial press writes that silver is too volatile and unserious, and not a real store of value. The retail holder reads that at his kitchen table with his stomach in a knot, and he sells. And every ounce he sells at the bottom of an engineered dip is an ounce that walks quietly into a stronger hand, exactly the way that pool of gold drained out of 8 national vaults and into the hands of people who understood the game. If you are holding silver right now, and every hard shakeout makes you wonder if you are the fool in this story, I want you to understand something. That feeling is not an accident. It is the product. It is what the machine is built to manufacture. Let me tell you about a man I will call Walter, because I want you to see yourself somewhere in this. Walter is a retired machinist. He did everything right his whole life, saved carefully, and some years ago he decided to put a portion of what he had into physical silver, real coins and bars he could hold in his hand. And every single time the paper price got clubbed, Walter's brother-in-law, who keeps all his money in the market, would needle him at the dinner table. "Look at your silver now, Walter. Should have bought stocks." And Walter would go quiet and wonder if he had been a fool. What Walter could not see from his kitchen table, and what I want you to see, is that the number that made him feel foolish was manufactured in a paper market by people who wanted him to feel exactly that. His silver did not get worse. His metal was still his metal. Only the number flickered. And the number was the weapon. Now, let me be honest with you, because a man who only tells you the bullish side is a man you should not trust. Silver can stay suppressed longer than feels fair. Paper can beat physical for a long stretch, and it has. A coordinated push of paper selling can pin the price down for months, even while the real metal grows scarcer underneath. I am not going to insult you by pretending I know the day this breaks, because I do not, and neither does anyone who is honest with you. What I can tell you is what that pool of nations proved. A price held down against the real physical pressure of the market is not held down forever. It is held down until the metal runs low, and then it is not held down at all. And this is the natural place to stop and take care of you, because right here is where the fear is real, and the stakes are yours. If you are a retiree with $100,000 or more sitting in a 401k or an IRA, I want you to know one specific thing, and it is not a pitch. It is a fact most people are simply never told. The largest, most sophisticated buyers on the planet, the central banks themselves, have been accumulating physical gold at a record pace, buying more than 1,000 tons a year for several years running, roughly double what they bought the decade before. They are quietly getting out of paper promises and into metal they physically hold, because metal in your own vault cannot be frozen, printed, or defaulted on. And here is the part almost nobody tells the ordinary saver. There is a completely legal way for you to do the very same thing inside the retirement account you already have. You can move a portion of those savings into physical gold and silver, real metal, without taxes and without penalties, through what is called a self-directed precious metals IRA. We put together a free guide that walks through exactly how it works. If you are watching this on your television, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. This is not just for insiders. If you have $100,000 or more in any retirement account, this is for you. Now, let me get right back to it, because the next piece is the one that actually matters. Because here is what almost nobody connects. Right now, in the real world of physical metal, the pressure is already showing at the seams. Look at the divergence that has opened up between the East and the West. In China, physical silver has been trading at a meaningful premium over the Western price, a real gap, because demand for the actual metal there is intense, and the government has choked off how much silver is allowed to leave the country. That is the sound of the machine straining. When the paper price in one place and the physical price in another drift that far apart, it means the paper is no longer telling the truth about the metal. It is exactly the moment before that pool of nations broke. when the official price and the real price split, and the split was the warning that the anchor was about to snap. And notice something else about this rally, because it tells you what kind of move this is. Even with the metals near their highs, the speculative crowd is not piled in. This is not a mania. There is no line around the block, no cab driver giving you silver tips, no magazine cover screaming about it. If anything, the big speculators have been trimming their silver bets, not chasing. That matters, because tops are built on euphoria, and there is no euphoria here. A market that grinds higher without a crowd is a market being pulled up by real physical demand, quietly, not by paper enthusiasm. That is the opposite of what a blow-off top looks like. That is what the early innings look like. Now widen the lens, because the same fingerprints are all over the history of these metals. When central banks around the world got a hard lesson that reserves held in someone else's system could simply be frozen, they did not write a memo. They accelerated their buying of physical gold, because a bar in your own vault answers to no one. Gold quietly climbed past other major reserve assets to become one of the most held reserves on Earth, second only to the dollar itself. And the old rules that used to govern the price stopped working. Gold used to fall reliably when real interest rates rose. Recently, it has climbed even as those rates stayed high, breaking a relationship that held for decades. When the old inverse rules break, it is because a bigger force has entered the room. The bigger force is the steady, patient hand of buyers who have decided they want the metal itself, not the promise of it. Here is the honest limit, so you never accuse me of selling you a fantasy. The one true enemy of gold and silver is a real return somewhere safer. When you can earn a solid, inflation-beating yield sitting in something risk-free, the metal has to fight uphill, and history shows a determined central bank can enforce that for a stretch and hold the metals down. That is the real risk, and I will not hide it from you. But look at where we actually are. Inflation has run above target for years. The Fed under its current chair, Kevin Warsh, is divided about what to even do next, and the market is no longer sure the next move is even a cut. In an environment like that, a durable real return is exactly the thing that is hardest to come by. The metal's one true enemy is the thing least likely to show up right now. And that is not even the part that changes how you should think. Come back to the machine one more time. The reason this suppression can persist is the same reason the pool of nations lasted as long as it did. As long as there is enough real metal available to hand over to the few who actually demand delivery, the paper game continues and the price stays capped. The London market holds an enormous float of silver, tens of thousands of tons, and a large float can quietly cover a structural deficit for a long time. That is what buys the suppression its years. But a deficit does not stop just because the surface looks calm. Every year the world uses more silver than it produces. That float draws down a little more. It is invisible, right up until it is not. That is the exact word for what happened to that pool of gold. Invisible, 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 and then overnight, gone. So let me talk to you plainly about your own position, because understanding the trap is worthless if you then walk right into it. The first principle is the simplest and the most violated. Do not sell your real metal into an engineered dip. That is the entire purpose of the dip. When they club the paper price and the financial press tells you silver is finished, that is the machine asking you to hand over your bars. And the correct answer is no. The second principle: own the metal, not a promise of the metal. A paper claim is exactly the thing that fails you in the moment it matters, when everyone reaches for delivery at once and discovers the claims outnumber the bars. And the third: size what you hold so that no shakeout can ever force you to sell. The people who get hurt are the leveraged and the impatient, the ones who can be squeezed. The people who hold real metal they own outright, sized so a bad month cannot force their hand, cannot be shaken out at all. That is not a stock tip. That is just how you refuse to be Walter's brother-in-law's punchline. Now, here is the recognition moment, and I want you to sit with it. The smart money already sees this. The central banks already see it, which is why they are buying real metal hand over fist. The people who understand the paper machine already see it. What has not happened yet is the moment the mainstream catches on. The pension funds have not caught on. The financial media has not caught on, or will not say it out loud. Your neighbor has not caught on. And that is precisely the point. By the time this is obvious to everyone, by the time it leads every news segment and every advisor is finally recommending it, the easy part will already be behind us. Nobody sends you an invitation to be early. Nobody is going to call you and tell you the pool is about to break. That pool of nations did not hold a press conference the day before it collapsed. It just collapsed, and the prepared were prepared, and everyone else read about it afterward and wished they had understood the machine a little sooner. Which brings me to why I do this at all. If you have $100,000 or more in a 401k or an IRA, and what I have laid out today makes you want to actually understand your options instead of just worrying about them, I hold a free one-on-one educational web conference for exactly that. No cost, no obligation, no pressure. Just a real conversation about how this works and whether moving a portion of your retirement into physical metal makes sense for your situation. If you are watching on your television, scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com and mention that you watched this all the way through. And here is the honest why now, with no fake countdown attached. The window where a decision like this is still calm, still cheap, and still fully reversible is exactly the window when nothing feels urgent. It never feels urgent, right up until it suddenly does. And by then, the calm decision is off the table. The quiet moment is the opportunity, not the panic afterward. So think back to those 8 nations pouring out their gold to defend a number they swore would hold, right up until the vault ran low and the whole illusion ended in a space of days. The people who trusted the reassurance got the shock. The people who understood that a price defended with a finite pile of real metal is living on borrowed time were already on the other side of it. Silver is sitting in that same shape right now, a mountain of paper claims balanced on a shrinking pile of real metal, and a machine built to make you hand yours over at the bottom. Do not be the one who bleeds it out afterward. Be the one who understood the trap and quietly, calmly refused to step in it.